Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This show today is brought to you by ShareFile. Look, check it out. We use them. It's an incredible way to do business and to, in commercial real estate, we do have a lot of sensitive documents, right? You got to check it out, sharefile.com. Well, I'm excited about the show today. I'm sure most of you out there have heard of CRE counselors, incredible group of folks who are kind of the upper echelon of commercial real estate counselors around the U.S. and around the world. And they do a report each year of the top 10 issues affecting real estate. Please welcome my guest. It's Anthony, goes by Tony DellaPelle. And he is the 2024 chair of the Counselors of Real Estate. He's also the managing partner of a law firm, McCurdy, Riskin, Olson, and DellaPelle, and they are headquartered in New Jersey. Tony, thank you for being with us.
Good morning, Michael. Thank you very much for having me. It's a real pleasure to be with you in person here.
Well, thank you. And I've always loved meeting all the CRE counselors that I've met over the years. And this report you guys do is, I always look forward to it because it kind of really puts in perspective kind of what's going on and what we need to think about moving forward. Tell our listeners a little bit about how long you guys have been doing this and how you do this report.
Sure. Well, our organization is made up of about 1,000 people around the world. We have members in more than 60 different professional disciplines in the real estate industry. And we're based in, I think it's 21 or 22 countries. So we've been doing a top 10 for about 10 years. We've only been calling it the top 10 for less than that. But the process works like this. We have a committee that is selected, which is geographically and professionally diverse of our members. They will then meet and start to identify the trends and the things that they're seeing in the real estate markets and industry. And they'll come up with a preliminary list. We then go out to the membership, do a survey, find out what they think matters, and then the committee reconvenes. They'll digest all of that. They'll pull the top 10 and rank them. And every year we release our top 10 issues in the fall. So you're going to have the first crack at this one for 2025, and it's our pleasure to be able to announce it here with you.
Yeah, well, thank you. And you've got some big names that are involved in this, right? That a lot of our listeners probably know and have heard of, right? Who are some of the folks involved in doing this?
The committee this year is actually led by a professor at the NYU's real estate program named Tim Savage, and then a woman named Maureen Ehrenberg, who's based in Chicago. It rotates every year. Yeah. Our organization has within its ranks people who are members and even leaders of some of the other commercial affiliates, like the SAOR organization, the CCIM organization. There are people that have those dual designations. So we try to find people that are going to give us a really broad representative view of the market as a whole, as opposed to one niche, like what I do. I'm just a real estate lawyer, right? Yeah. What do I know about debt other than my clients need it for their projects? But I'm not a lender. I'm not making loans, and I'm not underwriting them. And we try to make sure that we can canvass everybody with all the different knowledge bases that we have to come up with this list.
Well, good. And let's hit some of the highlights of these. And we're going to go from the top 10 and do the David Letterman style. We'll go backwards. And I think they're all important. I don't know that the order, and when I look at it, is that important because they're all top 10 issues are important. And number 10 is price expectations gap, and I'm a broker. So that's one near and dear to my heart that I deal with every day. What are some highlights about that?
Well, I think what we're seeing is that there's still a standoff when it comes to asset prices between the seller's expectations and the buyer's desires. The good news for us is that the gap seems to be getting narrower, and that the drop in asset pricing seems to be mitigated in the past 12 months as compared to where it was last year at this time. It's sector specific, obviously, because not everything moves up and down at the same rate. So if you're going to look at an office property in a central business district as opposed to an office property in a suburban area, that may have some different variables involved. I know my shorthand is, at least in the New York area where I'm from, in the suburbs, we're knocking office buildings down. In the cities, they're not. And there are reasons for that, right? But the pricing of those assets will basically be dependent upon what the sellers think they're selling, what the buyers are buying. And in a suburban office complex where you're going to knock it down, you're buying the land. Right? You're not buying the building to rehabilitate it into apartments. Right. So we think that we'll start to see some closure of that gap this year. It may be something that is actually either helped or hurt, depending upon how you look at it, by the debt maturities that are going to continue that have already started, because that may force the sellers' expectations to be diminished, and the buyers are waiting for those prices to come down so they can buy an asset at the right price and then hopefully make money off of it.
Yeah, that makes sense. And we're seeing the same thing. We're starting to see some sellers and all property types kind of realize, you know what, we don't have free money anymore. The equity and the debt is more expensive, and we're back to more historic rates, and the values are adjusting. And yeah, we're seeing some of the same thing. And well, number 9, let's go to that because that's a big issue as well. It's about office vacancies and kind of the tax base and what happens there, I guess, with the plummeted value and the health of the urban markets, urban cores. What's some highlights there?
So reports are that the national vacancy rate for offices is going to be around 20%, which is actually quite high. It's much higher where I am from and has been for several years. But what does that mean? And really what it means is that asset cannot have the same value because it's going to have a lower NOI. We also, as you'll see and hear in a little while, we know that expenses to carry commercial real estate have gone up, will continue to go up. So the net income stream is going to be lower. The problem is this, and there are a variety of them, but the biggest one is probably the fact that property was contributing to the local economy in various ways. And one of the ways that it was contributing to it was through the fact that it created a tax rateable for the local government agencies. So if you had a building, I have one in my office right now, it's a real estate tax appeal. The property was on the assessment books at a value of $35 million, and the buyers paid $8 for it. So what happens to that rateable when, if it's a small town in a state like mine, which is very heavily taxed, we have towns where 20-25% of the rateable base are represented by one taxpayer.
Oh, wow.
And then what happens if the value of that rateable goes down precipitously? You still have a budget to meet if you're the mayor. You still have to pay the expenses that are required to run the town, right? Infrastructure, fire, police, safety, schools. You have a cost for your administrative agencies to run, to plow the roads, to pave the roads, do all these things. And now that rateable base is shrunk. Who's going to pick up the tab?
Yeah.
It's going to eventually fall to the people who still own the properties.
Right.
And one of the countervailing actions that we have seen is that there are around the country an increasing number of efforts to cap property tax increases so that the homeowners who are still living there aren't going to see their property tax bill double or go up 50% in 1 year, because they might be able to put in a 2 or 3% cap. But if they do that, where's the difference get made up?
Yeah. Yeah, that's a good question. And I like how you mentioned that. It's just one of the issues, because sometimes if there's a lot of vacancy in some of these urban buildings, it impacts the real estate around it, right?
Sure.
And the businesses around it as well.
Who's going to go buy the sandwich or get their clothes get cleaned at the dry cleaner if they're not going to that office to get to work?
Yeah, that's right. All right, let's go to number 8 on the drum roll here. Sustainability. Talk to us.
This is not a new issue.
Yeah.
It's something that we see everywhere. And I don't even know if there was anything such as a LEED certified professional 25 or 35 years ago when you and I were starting in this business, but now they're everywhere. I think there's a divergence of opinion as to how important it is, depending upon where you are geographically, both in this country and in other countries. But the bottom line is this: there clearly is a growing demand for commercial real estate properties to be more sustainable, whether it's through their design or the way that they handle their energy. And those options are attractive to investors. So that we're seeing some market influence in holding out properties that are sustainable. There's also increasing government regulation. You know, Europe is ahead of the curve, or at least as compared to the United States on this, because they have regulatory standards in place that have already been adopted and are in place to report certain aspects of your properties. We have proposed that here in this country. I'm not sure if it's going to become law or not because of the way that the political system runs and works, but clearly lenders are more attuned to it. Investors are more attuned to it. We know that things like insurance and other costs have increased, and operating costs for energy and items like that are going to continue to increase. So they're being watched very carefully. by the commercial real estate market, and they will continue to have an impact as we go forward.
Yeah. Well, it's interesting to see when you have, value changes and transaction volume changes, how that impacts our ability to be sustainable, right? To spend that kind of money. And I know I've talked to some office building owners and I'm saying, why aren't you going to LED lighting? Why aren't you doing this? Why aren't you doing that? So, well, we don't have the money. We don't have the people. We don't have the time. I'm like, makes it harder. I've got to give a plug to one of the best sustainability people out there, my daughter, Alexandra Bull, and she does carbon footprint, wellness certifications, LEED certifications. Hi, Alexandra. All right, let's go to number 7. And I think this is a really big one. It's on everyone's mind, the impact of artificial intelligence.
Well, the answer I can give you about that one is we're not really sure where we're going with it because we're just getting used to it in our industry, at least. There are other industries that have used it, for more years, and they're more proficient in how they use it. I like to look at this one as being very similar to anything else in that if there's garbage in, there's garbage out, right? So the quality of the inputs, the quality of the information that's going in to tell that computer or computer system to provide you with meaningful information is going to depend upon the quality of what you put in. So far, most of the successful uses of artificial intelligence in real estate have been with respect to market pricing for multifamily, because there's a lot of data points, right? So the people who are in charge of those systems are putting in information that's reliable. I don't know how long it's going to take for us to all be very conversant in it, but one of the things that I keep hearing is that artificial intelligence, if you're in the real estate business, is not going to take your job. But someone knows how to use artificial intelligence better than you is going to take your job. And that's what we have to be on the lookout for. How can we all in our various sectors of the profession use this monster that's out there that has transformed many other industries already, and that's going to have a place in ours because we are a data heavy industry, obviously. And the more we understand it and know what it means and can have artificial intelligence guide us in how we use it, the better off we'll be.
Yeah. Well, it's interesting, the positives and negatives potentially of AI, right? I was talking to Casey Conway, and he was working on a case for a tax assessment, and the other side had used AI for all of their reports and information. And when they really checked into it, most of it was incorrect. So it's like, all right, somebody used AI, they kind of went the easy route, and the information was wrong. So it is kind of interesting when you talk about garbage in, garbage out, how that's going to impact things. Really crazy. Well, let's go to number 6. And, this has been a big one, and it still continues to be, and that's housing affordability. What do you guys see there?
I mean, that's the elephant in the room because we all need housing. We don't have enough affordable housing. It's classified and discussed in different ways in different parts of our country, at least. But the bottom line is there is not enough housing for people in the low middle income economic classes. We have a shortfall. We didn't really make much of a dent in it. I think the last time we probably had a surplus was 2007 or 8. And our shortfall has existed since the great financial crisis, when there was a contraction of new builds. So we're still about 4.5 million units shy in the country. I think that what it's going to take is a concerted effort between the private sector and the public sector to do things that are more creative than what we've done in the past, which, like in my state, it's all about the courts ordering the towns to be compliant, and they have to find solutions. Otherwise, they're going to have to pay penalties. But the bottom line is there has to be private sector involvement along with public sector initiatives to provide more meaningful opportunities for people to either buy or rent homes near where their jobs are or may be. And those kinds of things obviously are changing because of the impact of technology and the pandemic on job choices and locations, because people don't have to go to work in the office as much as they used to. Yeah.
Well, it's certainly a big issue. And, we see the solutions could be opportunities, right, for some folks. We've seen these micro apartments. We've seen, co-living. We've seen manufactured housing. We're seeing, conversions of sometimes of hotels and office and other properties. And it's been interesting to see what opportunities are out there and how we solve that one. But the next number 5 is like, is a challenge for the industry that I'm like, how do we fix this when that's insurance cost? What do you see there?
Well, how we fix it is to allow the insurance industry to fix it, right? Through competitive pricing and products and offerings. And we're not ready yet because I think we're still dealing with the direct impact of the rising costs and how people can afford it and how it impacts the bottom line on the real estate. It's not just your investment property, it's your own home, right? That has higher insurance premiums now. And the industry is in flux. The insurance industry is certainly in flux, knowing that there are rising costs. There are more and more events that require insurance to be used to pay for disaster recovery efforts and things of that nature. And I think it's gonna take several years for us to see it evolve, whether there are ways that people who own or companies that own a lot of real estate can aggregate the risk in some way by pooling together their assets and have different kinds of coverage, or whether there are other incentives provided through the public sector. I'm not really sure where it ends up, because right now it is clearly that and property taxes are the two most important variables to folks. As much as we know that debt, which we're going to talk about, is the most significant one, I think the two biggest wild cards are the property taxes and the insurance costs, because the fact that they're usually the next two biggest costs after your cost of financing. And whether we can predict what's going to happen with the debt markets or not, I think that they're a little bit more predictable than these other two. Yeah,
that's a good point. It almost seems like, it's one I just don't really see a solution if our hurricanes, tornadoes, flood, if all this is getting worse, right? Over time, it's like, where's the solution?
And also, don't forget about the fact that if your property insurance is going up, your casualty insurance is also going up, because the industry doesn't give you insurance to lose money. They have to make money. So if all of those other costs are going up, the casualty premiums are going up as well. And that's part of your bottom line too for your property, isn't it? So finding out a way to get it to work other than raising prices to your consumer in the form of rent or sale prices has to happen. Otherwise, we're going to reach, in a relatively untenable stage where that's also going to end up affecting the bottom line more than it already has.
Yeah. Maybe we need some nonprofit solutions. I don't know. It's crazy. Well, let's go to number 4, geopolitical and regional wars.
Sure. When's the last time that you could look at the international news and not read something about some major strife somewhere outside of the U.S., whether we're involved or not? Something as simple as the Middle East, which has never been simple, but from a real estate perspective, maybe can be looked upon pretty simply. Years ago, when we were kids, we always talked about how strife in the Middle East led to higher oil prices. So we go to the gas station, we pay more for gas in our cars. And now the more recent ones, they're going to close the Suez Canal. And that's going to affect shipping of goods that come here to our country. So what happens elsewhere in the world has a more direct impact upon us than it ever did, because the world has shrunk because of technology, right? And because our transportation systems have improved. So every time there is a conflict somewhere, whether it's Russia and Ukraine or the Middle East or something that may happen in the Far East, we have to look at that. We have to understand how it might affect us here in the United States, and ultimately how it may affect the asset pricing. I had seen during the pandemic, just as an example, we had a proliferation of matters involving cargo container yards near the ports in the New York area. And those pieces of land, they'll stack the shipping containers. They tripled in value in 3 years.
Wow.
When's the last time any asset could triple in value in 3 years? Right? Amazing. And then what does it do to the market participants, right? And what does it do to the people who not only buy, own, and lease that land, but the shipping companies, where they have to pay more? Where's it going to end up? It's going to end up costing you more, and there we go with inflation.
There we go. Yeah, that's a vicious circle. All right, and this is a real big one that we're all dealing with today. And number 3 is loan maturities and debt pricing.
It's been a couple of years now that people have been talking about that wave of debt, the wall of debt, the bomb, whatever you want to call it. I haven't seen it yet. We haven't seen it yet. We have seen some of its effects so far, but it's, to us, what we are hearing and seeing and witnessing in our own industries in our own clients and constituents bases is that for the most part, a lot of the debt maturities have been extended.
Mm-hmm.
So they're kicking the can down the road. It doesn't mean that there aren't loans that are coming off the books at 3.7% that now have to be recast at 7.5% or whatever it might be.
Mm-hmm.
But they're postponing the inevitable because maybe the lenders and the borrowers are waiting for things to become more normal. I think if we learned anything in the past 5 years, we shouldn't expect that things are going to be normal in the future like they were in the past. And we don't even know what normal is going to be. But the bottom line is there's still close to $2 trillion of commercial real estate loans that are set to mature in the next 2 years. What happens with that?
Yeah.
Even if it's a fraction of it that gets repurposed, isn't it going to affect the market or markets for those properties and those classes of properties? Because you can't recast a loan that was at 4 at 4.5, right? You can't. It's not going to work. It's probably going to be in the 7s. And eventually lenders aren't going to get to extend them anymore. So that wave, wall, bomb, whatever you want to call it, we think is still on its way. Maybe it will be smaller, or if there's more than one, will be smaller because of the efforts by different market participants to mitigate it, to try to protect their assets and their institutions. But it's coming.
Yeah. Well, it's interesting that you talk about it still on the way, and I get really involved helping banks and lenders and borrowers with distressed real estate. In the last recession, we did a tremendous amount of it, and what I saw there was a lot of delay. Just we talked to banks, we don't have any problems, and then boom. Yes, we do have problems. Let's fix it and deal with it. So yeah, it's like that shoe's about to drop. And of course, we're seeing some of it. You're seeing some of it as well. We're listing foreclosed office properties and others for banks, and buyers are getting some remarkable opportunities already. So I think we're starting to see some of that. It'll be interesting to see how much comes up in the next year. Well, let's go to number 2. It's a really big one. Drum roll, because maybe there's some good news along with the challenge. That's the cost of financing.
Well, this is obviously related to the topic that we just talked about, and they are all related to each other, aren't they? Because that's the way that the market works. Everybody thinks there will be a decrease in lending rates. I don't know if anyone can tell you how much it will be and what impact it will have. But even if rates are reduced a little bit, they're not going to come back to where we were. I mean, we had this unusual situation for basically 13, 14 years where you could borrow money for next to nothing. Right? I don't know when you bought your first house, but when I bought mine in the late 80s, my mortgage was 12%. And then I was happy to get it under 10. I refinanced it to 9.75, and then I went to 7.5, and then I went to 6, and then I went to 4. And the mortgage that I have left on the house that I'm about to sell because I'm an empty nester is 2.75%. It's never going to happen. At least I can't see it happening in our lifetimes unless there's some cataclysmic series of events where the government makes it happen like it did in 2007 and 8 and 9.
Which means there's a problem.
That's right.
So I don't know that we want that. We want more historic normal rates, right?
Right. But what is normal? Right, Michael? I mean, if you want to buy a property, let's say it's an apartment complex, what kind of mortgage are you going to get on that now? Right? It's not going to be 4%, is it?
No.
If you have a great relationship with a lender, it's a local lender that's invested in the community, maybe you do a little bit better with them than a larger institution. But if it's on the books with a 3.75% loan and you want to buy it and you can't get financing under 7%, isn't that going to affect your expectations as a buyer?
Absolutely.
And whether the people who own the properties now that have those debts that are coming due are going to just hand over the keys or not. We've seen some of it happen already. It's going to obviously affect the market. I think that you might see a little bit of a blip if rates do come down, because it'll bring more buyers into the mix that have been waiting on the sidelines, because they may think that it's a temporary blip and they can lock in their financing at low rates, even if not historically low, and be able to carry the asset as rates go up.
Yeah, that's a good point. And what we see on the brokerage side, which may be kind of the front line of activity, is that I think the fact that the rates are not going up anymore and they may come down gives lenders and borrowers and buyers more confidence in their underwriting. Right? When we didn't know if rates were going to go up more, it's like, all right, well, how do we underwrite anything? And I used to hear in the last recession, and in this one, I've heard a little bit, don't want to catch a falling knife, right?
Sure.
Well, it looks like now we're seeing that buyers and sellers feel a little more comfortable moving forward. There's been, some sales, so, they can understand values and pricing, and they can understand that, hey, maybe rates aren't going up, so we can trust our underwriting. So I think it will be interesting if the Fed does lower their rates even a little bit. It's a signal, right?
We're also seeing some easing in other countries in their, in their rates, and that's usually a signal that it probably is going to come here too.
Yeah.
But how much? Who knows? We have an election coming up, which we're going to be talking about in a minute. That could affect what the Fed does, and when it does it. It could affect market behavior as it usually does, and we just got to keep an eye on all these things.
Yeah, good point. And so that leaves us to number one: global and U.S. elections.
Right. So we have a presidential election pretty soon. It's not the only election that's out there, but it's obviously an important one for us because we live in this country and because of the fact that many foreign investors look to United States investments as being the safe haven when things are in turmoil in their countries. We don't yet know what will come of the results of the election, depending upon who wins the presidency and how the houses of Congress are going to be changed in some way as far as their their influence. But think about a couple of issues that could be affected by the outcome of the election. One is rent control. Should the federal government establish rent control protocols, or is it a local issue, right? Politics, interwoven into the business world and the real estate community. It's a tough issue, isn't it?
Yeah.
What about the ability to use a like-kind exchange vehicle, like so many of our clients, friends, maybe we did too, to make real estate investments work? What if it's eliminated? Certainly it's going to change. And what if it's changed? And now you can't use the 1031 vehicle the way that you used to. Isn't that going to affect the market? Just those two things alone are really big indications of how the political outcomes of the elections could influence us in the real estate market. We got to keep an eye on it. We're probably not going to see direct impacts of those kinds of things right away. But usually what does happen is after there is a new executive, let's assume there is one. Actually, there have to be because Biden's not running anymore, right? So we're going to have a new executive no matter what. They will likely have their administrations issue a series of executive orders to try to kickstart things to get them going. Then the legislature has to look at that stuff and decide whether it's okay or not. And many of those things do require congressional approval. So I don't expect that those changes are going to come overnight. But I do think that sometime next year, you'll start to see some decision making at the federal level and then at the state and local levels to follow that, which could have an impact on what we do for a living.
Yeah, and I'm I'm glad that's number one here because one of the things in the Harris proposal for moving forward for the budget is there's a paragraph in there about that limiting the 1031 or doing away with it and called it. Referred to it as fat cats, rich people benefiting from it. And, I think it's been around 100 years. And, we have to get to the congressmen and to senators and help them understand, and the young people who work for them, that what it really does for the economy, why it's been around for 100 years. And if they do limit it, it could hurt banks, it'll hurt neighborhoods, it'll hurt farmers, it'll hurt mom and pops who flip houses, it'll hurt housing. It would be a really drain on the economy. And there's reports and things that illustrate it. It's pretty clear, but it's like we have to educate them every time. And I think regardless of who wins, that's a message I think in the commercial real estate world, we got to get out there.
I had an experience about 10 years ago where I was asked to write some statewide legislation regarding local redevelopment laws in New Jersey, which are very prevalent in my state. And watching that legislation, which I helped to author, get enacted into law was a really fascinating experience for me because they say you don't want to watch legislation get made. It's like making sausage, right? That's what they say. We have to be mindful of the fact that anytime there are new people in charge, they're going to want to try to bring their policies forward because that's why people elected them, right? But that doesn't mean that their policies all become real, right? They're stifled in some ways. Maybe they realize that they shouldn't do, if they had 10 things on the wish list, maybe they're only going to try for 6 or 7 of them. And of those 6 or 7, maybe only 3 get through.
Yeah.
Because of the countervailing policies that the other people, even within and outside of their parties, have. So it's clearly a big deal. It's something we have to watch. It's going to have an impact on real estate in the next 4 years. And the trickle-down effects of what happens on the big platform, the national platform, into the state and local government agencies and communities is something that is clearly going to have to be watched by those of us who have more local or regional practices in what we do.
Yeah, good point. Well, what would you leave our audience with, Tony, to think about regarding the top 10 issues this year?
I think the key takeaways to me are recognizing that there are probably as many or more unknowns than there ever have been. If you used to own a building in Atlanta 100 years ago, I don't think you really cared what happened in the Ukraine, right?
Or who was the president.
and you probably didn't have any partners or investors that weren't from this area. Right. But if you have international funding sources or partners and they're affected by what happens in their countries, it's going to affect you. We are all tied together more than we've ever been. And that's going to continue. So I think in addition to knowing that there are a lot of risks out there and a lot of uncertainties, the more you can be knowledgeable about how they may all be related to each other in influencing your decisions and how you go about your business, I think the better off you'll be. We hope that through education, both formal and informal, by meeting with people who are in these other industries and learning what's happening to them and then reporting on it, discussing it, and figuring out solutions that will find a path forward. But the next 4 years are going to be interesting. If I came on this show in the fall of 2019 and told you that we had to figure out a solution for the affordable housing crisis, I would have been right. But I don't know that I would have been able to predict anything else that happened, in those 4 years, because who would have thought that interest rates would have gone down even more? But they did. And there were reasons for it, weren't there?
Right.
If I had told you you could have bought a piece of land that had gravel on it 2 miles from the port of New York for $1 million or $1.5 million an acre, and then you could have sold it 4 years later for $7 million an acre, you would have scooped all that up. But we didn't know.
Right.
We had to figure it out. We had to watch. We had to react. We had to make our decisions, hopefully with a good level of information, and then keep our fingers crossed, because you always have to do that too, don't you?
Yeah, well, that's a good point. I think the same thing could happen in the office world as, some of these buildings get torn down, as you mentioned earlier. Some get converted, new supply stops. So these folks buying beautiful buildings for under $100 a foot that cost $500 or $600 a foot to build. And when you have the natural growth of a market that will, increase demand, some of the back to work office is happening with some of these companies getting them back to the office. So I think we could have a similar situation there where investors get into some of these office buildings and have real windfalls. It's amazing how things can change faster than we think.
But what are you going to do with those office buildings is really the issue, because you can't just take an office building and turn it into apartments, right?
No.
There's a lot that has to go into that.
Yeah.
It's a lot of risk. It's going to cost a lot. Some of the physical configurations, or many of them, don't lend themselves to residential conversions. So those opportunities, while they're out there, and while we've heard that less than 10% of the commercial business district office stock can be converted to residential, but still 10%, that's not so bad, right?
Yeah.
They have to pencil out.
Right.
And if you figure out that office building needs light in the middle to lend to the new apartments, you got to cut a hole in it.
Yeah.
Right. You reduce the square footage. It costs a lot of money to do that. You got to bring cranes and go down or go up. The architects, the engineers, the contractors, they're going to all have a ton of work to do. But I don't know if the investors can look at those opportunities and expect that they're going to be easy rides, especially when you layer in all this other uncertainty.
Yeah. Do you expect to see more tax incentives for conversion to residential?
Don't there have to be?
Yeah.
I mean, if the private sector can't make it work on its own, but it needs to, for our society to heal and improve and figure out solutions to the problems that we have as they relate to real estate, that's government's job.
Yeah, that's true.
Right? To work with us to figure out ways that the government's power, influence, and policymaking ability can help. Yeah. As an example, we took our redevelopment laws in New Jersey and amended them in 2019 to allow the government to use eminent domain to take office or retail properties that had substantial vacancies for more than 2 years. So that zombie mall that maybe the owner just kept it on its books because it could carry it. Now someone can take that, knock it down, build affordable housing on it or something else, because the government reacted and it said, this is a good thing for us to do. Whether it is good or not, that's for people to debate.
Right.
But they thought that, they did it, they got it through, and there are people who have actually been able to make projects work because of that government incentivization.
Yeah. Well, might need more of that. If the 1031's limited or are depleted, there'll be more folks who don't want to sell properties and more dilapidated neighborhoods and more challenges for the tax base. So back to the tax incentives, I think if there's some incentives from the government for conversion to residential, obviously it helps everything around it, right? The tax base, it helps the properties around it, their tax base. So yeah, it does need to happen.
And is it really any different than what was experienced in historical times? I mean, you had farms that got turned into towns and cities and housing developments. Now we're looking at different kinds of properties, right? Old warehouses, old mill buildings, old factories. There's not too many of those around anymore, are there? So the repurposing of the real estate assets and how they work has been going on since our country was founded. Yeah. I think that the influence of current conditions is greater now, and there are more risks and uncertainties, but eventually real estate's about location, right? Those are the 3 cardinal rules of real estate. And if you got a well-located piece of property, someone's going to find something they can do with it that will enable them to use it profitably, to make money off of it, and to help the community in whatever it provides. Yeah,
well, good point. And, the old location. I would say also today, I think more of timing. And Tony, thanks for your time. Great information.
My pleasure. I really enjoyed being here with you today.
Thanks for joining us here in Studio One. We appreciate it. And thanks for joining us around the country. We appreciate it. Hey, if you will share the show, I would also ask you to understand each potential president's tax plans, especially related to the 1031 exchange. Read it, understand it, read the reports, and know what's going to happen, and so you can reach out to your senators and to your congressman and let them know what you think, either way that you think. So thank you for joining us. Until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Bull Realty, commercial real estate sales, leasing, and advisory services. Visit bullrealty.com or reach out to me directly. My email is michael@bullrealty.com. By ShareFile, designed with real estate and other highly regulated industries in mind, ShareFile offers secure digital solution to simplify workflow and improve collaboration. Visit sharefile.com. By Commercial Agent Success Strategies, 21 cloud-accessed agent training videos. Learn more at commercialagentsuccess.com. You're invited to subscribe to the show wherever you listen or watch the show. You're also invited to subscribe to a weekly email announcing the show topic and guests at creshow.com. Thank you for watching, listening, and sharing America's Commercial Real Estate Show.